Alright, let's talk about the whispers. You know, those hushed conversations around the water cooler, the speculative headlines popping up in your feed, all asking a single, unsettling question. Is Bread Financial in trouble? It's a question that can send shivers down the spine of investors and consumers alike, especially when we're talking about a company that's deeply intertwined with the credit and payments landscape. For many, Bread Financial might sound like a new player, but they've actually been around the block, previously operating as Alliance Data Systems. They're a significant force in the private label credit card space, partnering with numerous retailers to offer branded credit solutions. Think about those store credit cards you're offered at checkout. There's a good chance Bread Financial is behind them. They also offer general-purpose credit cards and buy now, pay later solutions through their Bread Pay platform. So, when concerns surface about a company of this scale, it's not just a blip on the radar. It has the potential to ripple across the retail sector and impact millions of consumers. The financial world is a complex web, and a company's health isn't determined by a single factor. It's a combination of revenues, profits, debt levels, credit quality, and overall market sentiment. Lately, there's been some chatter about Bread Financial, fueled by a few key areas that warrant a closer look. Firstly, let's consider their earnings. While they've reported some mixed results, their first quarter 2024 operating income missed analyst estimates, and the bottom line saw a significant year-over-year plunge. This was partly attributed to lower credit sales and a decrease in average loans, as consumer spending began to moderate due to persistent inflation and higher interest rates. The company itself acknowledged the impact of ongoing strategic credit tightening, meaning they're being more cautious about who they lend to, which can affect loan growth. Another point of scrutiny is their credit quality. In the first quarter of 2024, Bread Financial saw a deterioration in both their delinquency rate and net loss rate. This suggests that a higher percentage of their customers are falling behind on payments, and more loans are being written off as uncollectible. While these numbers can fluctuate and the company has been taking proactive measures, a sustained increase in these metrics could signal underlying stress in their loan portfolio, especially given their focus on what's often considered a higher-risk borrower segment. Now, let's look at the bigger picture, the economy. High inflation and rising interest rates create a challenging environment for consumers. When people are struggling to pay for everyday necessities, discretionary spending often takes a hit, and managing credit card debt becomes harder. This macroeconomic backdrop naturally puts pressure on companies like Bread Financial, whose business model relies heavily on consumer credit. However, it's not all doom and gloom. Bread Financial has been actively working to strengthen its balance sheet. They've been focusing on improving their capital ratios, and their Common Equity Tier 1 (CET1) capital ratio has shown an upward trend. They've also been reducing parent-level debt and increasing direct-to-consumer deposits, which diversifies their funding mix and reduces reliance on wholesale borrowings. Their credit ratings from agencies like S&P Global, Fitch, and Moody's remain in the BB- or Ba3 range, generally indicating a stable outlook, though still in the non-investment grade category. Looking at their stock performance, it's been a bit of a roller coaster. After a dip in early 2023, the stock has generally trended upwards, recovering significantly. As of early July 2025, the stock is trading around $60, showing a notable rebound from its lows. This suggests that despite some concerns, the market isn't necessarily predicting an imminent collapse, and there's some confidence in the company's ability to navigate current challenges. Ultimately, is Bread Financial in trouble? It's a nuanced answer. They're operating in a challenging economic climate, and their recent financial results show some signs of pressure, particularly regarding credit quality and slowing growth in certain areas. However, the company is actively working to shore up its balance sheet, diversify its funding, and adapt its lending strategies. Their credit ratings are stable, and the stock market seems to be cautiously optimistic about their ability to manage through these headwinds. It's a situation that demands continued monitoring, but it's not necessarily a full-blown crisis. With that said, thanks for watching, and until next time.